Hey guys, Freaky Finance here. Last week we looked at Geo Group REIT, or profit prison play with a immigration offset, and this week we're going to look at CooTek. So if you remember when I did my little annual review, I was talking about slowly rotating out of America tech and going into China tech, and I've started doing that. And this is one of the companies that I'm currently in. So I'll show you this before I start. You can see that I'm currently in an average price at $372. So down 17%. This thing's pretty volatile, and I'm currently on the fence about adding more, and today we're going to go through it. So CooTek is a very small in market cap company in China, and it's growing very quickly. It's like a mobile internet company that gets all its revenue basically from advertising. So you're going to see the terms monthly average user, which is MAU, and they're growing fairly aggressively, I'd say, at least on a year-over-year basis, and lately they've kind of stalled out, which is one of the reasons why it's getting cheaper, I think, as well as tech in general has been selling off, both in America and in China. Some people are calling it the tech wreck, but so anyway, this company, they have this Fendu novel that's recently been growing and, more importantly, retaining users. So you can see right here, not only is the daily average user over 10 million in October 2020, but the average reading time is more than 2 hours a day per user. And that means people are using it, and obviously when you're reading novels, you're going to be reading for quite some time, because it usually takes some time to go through a book. So there's a lot of room here for ads, and it appears so far that the users are, at least on the surface, fairly sticky to date. One of the reasons that I'm looking at it, and why I'm in it, is because the revenue growth is rather ridiculous. So you can see here, net revenue grew from 37 million for the year in 2017 to 134 million in 2018, and then it went up another 32%. So a little bit choppy, right? You're going from a 250% to just 32%, but you're up 177.9 million a year. But then all of a sudden, you're going into 2020, and 9 months in, you're already at 339 million, and you're guiding to around 445 million on the year. So you have this another almost like a crazy growth period again, and it's software, so the gross margin is relatively attractive, right? Because it's literally just the more users you bring in, the more revenue you bring in ad dollars, and your cost of goods sold stays fairly constant. And we're going to go through that in a second. So their products, though, before we jump into the numbers, mainly there's three segments, I'd say. There's online literature, which is the one where they're currently putting most of their resources and where a lot of the growth is coming from. And they have these two, I'd say, older segments, which is their scenario-based contact apps and their casual games. So I don't think any of these casual games are anything special or anything like that, but they do generate a material part of the revenue currently. So this one is the latest, I'd say, biggest grower and focus for the company. So for Q3 2020, you can see the revenue split. It's 41% for that casual game part, 34% for the online literature, and then 24% for the scenario-based. And I expect this side of the pie to slowly increase the others as it keeps growing. We'll have to see how that plays out over time. So the revenue, like I said, it's strange, right? So it slowly slopes up, and it slopes down, and then it just shoots up. And it's material growth, right? So you're talking about $30 million more quarter over quarter, then again another almost 40 million quarter over quarter, then 25. Then all of a sudden it started stopping and declining. And again, they're guiding only like around this number again for Q4. So I don't know if that means it's like on a slow downtrend again, then it shoots back up in another big wave. But it seems to follow this wave-like pattern in revenue. It's not linear growth up. So I'm going to jump into the numbers themselves. So immediately, we're going to talk about the growth again in revenue. You can see this is on a 9 months. The annual is going to be out March 25th, which is pretty soon. So I'm going to probably do an update on it after the fact. And one of the reasons why I haven't averaged in on its position yet is because I want to see the Q4 numbers and just to see the DAU, really, the daily average users, sorry. And then I'll have better information to decide if I want to add some more. Because normally when I'm in that down, I want to say 15 to 20% range, I'm probably going to start taking in a full position as long as the information doesn't change. So I'm going to wait for the information before I make that decision. But anyway, for the Q3 year over year, or 9 months year over year, you can see the revenue growth is there. You're up almost triple in revenue in the same period, and your COGS barely increased. So that's what we'd expect in a software play. That's really dependent on daily average users and monthly average users. And you can see the GMD is very high. This is American dollars, right? So, and again, there's always a risk premium here because you're dealing with Chinese companies on American exchanges. So it's always a tricky thing. You never want to bet too much on a company in general. And then even now, even though there's a lot of growth, you don't know how much of this is real, kind of. And we'll go through that as well. But there's always this extra risk premium you have to be aware of. But at the same time, most of my portfolio is heavy into either America or Canada. So I'm trying to get more exposure worldwide. And this is an interesting one for me anyway. So those first three line items basically look too good to be true. So then we look at the fourth one and you can see sales and marketing. And so they spend almost all their gross margin dollars on sales and marketing. In fact, in the latest quarter, they actually spent more in sales and marketing than they brought in revenue. So they are spending a fortune on attracting new customers to the platform. So the reason why the daily average users is so high is because they are spending a lot to get them on the platform. So now you need to make sure that you have the content to keep them there. And that's the biggest risk and the biggest possibility for reward, right? So they need to execute on that. But right now they're spending a fortune on attracting the customers to basically their apps or their platforms. R&D did not increase in line with net revenue, so scales, but it still spends a fair amount. If you look down here, you can see it was spending about 20% of its revenue, but its revenue just tripled year over year. So now they're only spending 6.8% R&D in revenue. So still a fair amount of R&D going on. Again, in millions of dollars American. And G&A, importantly, didn't increase at all, so that's sort of scale. Really, the only line item that looks, well, it's not necessarily poor, it just stands out is because they spend a lot in sales and marketing. But again, they're trying to attract more users. That allows them to keep scaling. So one of the things that'll be interesting is eventually you're going to want this S&M to go down while net revenues either stays constant or goes up, right? That's going to adjust it if this truly is sales and marketing and not a cost of goods sold. So that will be interesting to see when that happens, how the numbers look and how the stock reacts. Like if it legs that, I'm going to jump on it. But right now, basically whatever they make, they're spending to attract more users. So it's very high growth phase. And there's a risk there that this high sales and marketing doesn't attract more users, right? And then they're stagnant in growth and they keep just spending to try to grow. The share price is very volatile. And the spread is like 10 cents. So you wouldn't want to take a big position in this company anyway. So yeah, the ADR is 50 shares to 1. So 61 on the New York Stock Exchange under ticker CTK. And you can see the equity market cap actually go down. And that's why I got excited and bought in, right? Though I'm in at 370. But you can see the company's revenue shot up triple. But you can see the equity market cap just got shot. 37% cheaper on 3x the revenue, but the same loss. And this is kind of weird. I don't know how many of you guys are familiar with tech in general, but in America, tech, I want to say, is trading at a multiple of revenue. So, and especially right now, during COVID, the multiples, I want to say it's over 20 times the revenue, I want to say, maybe 15 times on average. So you would expect, if this is their revenue, and say their guidance is 450, you would expect that to be a multiple of that, not a fraction of that. So how does a company that's about to make 450 million in revenue only worth 193 million in equity? And there's no debt yet on the balance sheet as of this date. So it's very strange. Another thing that's strange is that the assets are pretty much all tangible assets. There's no goodwill. And in my mind, that's kind of odd because I saw how lumpy the revenue was. So I thought maybe they acquired it to get that year-over-year increase. But I mean, there's no goodwill, so that means they did it organically, or at least that's how my brain translates it, or at least they didn't overpay for growth according to their accounting. The only year-over-year decrease in tangible assets is that they sold 13 million short-term investments. The liability side, there's not a lot there. It's basically AP and 14 million in short-term bank borrowings. So AP is bigger than cash, but they are as well. So they are going to need money though to finance these losses, because they're spending a lot of their cash flow that they generate in GMD back into acquiring more users. And it does have $182 million in accumulated losses. So on the metrics side, GM margin looks ridiculous, right? Software company. There's not very much in cost of revenues in order to generate those revenues. S&M expense, very high. You're spending 93% of your revenue you're putting back into S&M on a 9-month basis. And that number has just been increasing lately. And your R&D expenses just basically stay flat, but revenues tripled. And this is the important part, is the DAU. So the DAU, daily average users, you can see the main thing is you want this to slowly keep increasing over time. And then you also want the MAU to slowly follow it. And we're seeing it is going up, especially the DAU on the online literature side. And they are spending more than 2 hours per day per user. So that's also a very strong metric. So to me, I just note to myself, it appears that people like the online literature product, and it appears the advertisers do enjoy advertising on the platform. So that means it should be working. I mean, when you're generating 100 million in revenue a quarter, right? Obviously, the advertisers see some value there. Balance sheet is weird, given no goodwill and no debt. To me that means organic growth and financed by equity, or they made acquisitions under the fair market value of what they're acquiring. That's just how my brain translates that. The cash flow statement, we'll talk about that in a second, has no details, doesn't break down anything for me, so I can't dig deeper. So one of the things when you're dealing with a company, especially an ADR, Chinese ADR, I always try to find details, right? That's kind of my edge. And this company, it's harder to do that because there's less there. And the cost of acquiring new customers is very high. I've kind of already talked about that enough. That's the main con with this, is that they spend pretty much what they make to get more users. So the quarterly trend, it looks good, right? I'm getting a cheaper price than I was last year, but the revenue has gone parabolic. So it's basically the market either doesn't know about it, or doesn't want to touch it, or doesn't trust it. It doesn't trust the numbers. Maybe that's what's going on. But it's very strange because the advertising dollars are there, right? Now what it could also be doing is lately, because the growth has stopped and it's kind of stagnant, even though they're spending quite literally more in S&M expenses than in revenue on the latest quarter, the market might be starting to try to price that in, saying, okay, they stopped growing and they're still losing money, so we're just going to start slamming the share price. And I'm not sure about that either, right? There could be a lag time. There could be a lot going on, but we'll see. I mean, obviously, if it stays here and it just keeps spending S&M and it's not growing its advertising dollars, it's kind of strange. The main metric here to look at, if that happens, is the daily average users, to see if that keeps going up over time. And then we could ask the question to management, why is your daily average users going up but your revenue's not? So that will be interesting if that happens. It's one of the things that I'm looking at, right? Because every other thing, this is a very simple business model, right? They're really just trying to get as much ad dollars as they can, which comes from the daily average users. And the daily average users comes from the S&M marketing. And what I want to find out is when they scale the S&M marketing back, how does that look? So say if all S&M, say if they decide they can cut this by half, that means the company is very profitable. But that assumes that the revenue doesn't go down. So how much of that revenue is sticky once S&M declines? That would be my biggest thought, right? If it truly is S&M. Because in my mind, if it's actually required to grow and generate, it's one thing to required to grow, but it's another thing if it's required to generate the revenue. If it's required to generate the revenue, then this shouldn't even be called S&M. It should be cost of revenue. That's just, because it's flagged as S&M, it tells me that it's not required to generate the revenue. So if they pull this back, they should be able to generate at least what they're currently generating, right? And that's what I'm not sure about. So that's what I'm scared about. So that's why I haven't bet more on this, because it looks kind of silly in terms of a revenue multiple for a software company. And the other con is the cash flow. So you can see it's cash flow negative, specifically in the CFO. And that's what we'd expect, the cash from operations. So normally I'd be able to see more lines. Like the cash flow statement usually isn't 6 lines. I'd be able to see exactly what goes in here. But for some reason, they don't break it out on here. So using operating activities minus 14 million. And that makes sense. I mean, you're down 28 million. So cash flow from operations has been negative somewhere, and they're adding back something back in. Probably share-based comp. All right, so like I was saying, the cash flow, the CFO is negative. Cash use and investing activity is positive. And that links at least to the balance sheet, because we saw the 13 million less in short-term investments. So they sold some assets basically to finance the cash flow from operations decline. So one of the things that's going to be interesting, and what we're currently seeing as of at least March 19th, is that they're financing these CFO cash flow negative by convertible debt. We'll talk about that in a second. So we're going to start seeing that on the balance sheet. So the more this company spends, the worse the balance sheet's going to get. At the same time, if it can get the daily average users up and can actually show that if they don't spend the same amount on S&M, that they're still able to generate the same dollars of advertising revenue, if not more, then we're fine. But the thing is, we're right at that kind of I'd say the crossroads where we're not sure what's true. If it truly is S&M, then this company is probably a steal. But if it actually is required in order to keep the revenue, then it's not. So it's kind of an interesting time to look at the company. And I'm excited for the annual numbers coming out next week, especially if they give guidance for revenue for 2021. So back to the slides. So the daily average user trends, again, that's going to be the key metric. It is going up, but you got to remember they're spending $100 million US a quarter to get this number. right? So these are very expensive users. And how sticky are they once that spending falls off? However, for reference, the company is super cheap, right? I said it trades at a fraction of revenue. This is like, say, 0.5 revenue. Whereas American companies, say like Roblox, which don't get me wrong, has 170 million users versus daily average users at 94 million, right? So Roblox is twice as many daily average users, right? But Roblox priced at $40 billion and CooTek priced currently under $200 million. So you see the disconnect there, right? So there's a huge discount here on this company, mainly possibly because they don't trust the numbers, right? Or maybe no one knows about it. It's not hyped. And again, whenever they talk about every line item, it's very a small little blip. Basically, they're just saying sales and marketing expense increased 222% from the same period last year, and they just say the largest component is user acquisition costs. So it's acquiring a lot to get the users on their platform, and they are trying to keep investing to expand the use base of these platforms for products and cultivate the content ecosystem. Basically, you want to find a way to keep them there and for the content to keep almost growing on itself. The management team, I usually don't talk about too much about management, and you can see, yes, 3 of them worked at Microsoft before they started their own company. Microsoft engineer, also worked at Intel China, and they all have fairly good qualifications. I already talked about the average reading time keeps increasing, so it was 110 minutes last quarter, or Q2, and then 130 minutes at Q3. So like I said, they have to finance their because they're currently spending pretty much all their free cash flow, or GMD generated, in sales and marketing. So they have to finance this somehow. And so this, 2PN is giving them $20 million basically at a time. So this was as of January 25th, 2021. This one was just yesterday, March 19th, 2021. Convertible, 5%, so fairly low interest rate, another $20 million. So obviously they are spending more than they're generating to keep trying to grow the business and grow the content. This one has a fixed conversion price of $5. So like I said, it's currently at $3.18, so quite a premium. This is actually not bad, though. One of the things I didn't like is that right down here, I mean, they might have raised 20 million, but the banks get 2, so they get 10% right off the top. So not cheap access to debt in my mind, though. I mean, 5% interest isn't bad, and the convertibles, I mean, it's back over 5, only at 310, 317 now. Not amazing debt, but not crazy expensive for a software company. Well, the software company's growing like crazy, right? You're gonna 450 million. That's almost $500 million in a year in revenue, and the company no one knows about. All right, so this is what they're kind of trying to do: spend money and basically drive more content to their novel, their online literature. And I think this is clever. So they currently have 3,000 writers available to continuously come up with quality online literature. And so I didn't really talk too much about the AI side of this, but basically the AI says these are what our users want, and it tells these writers these are what they want, and then the writers make them, and then whoever gets the most basically eyeballs gets rewarded. That's kind of how it works. So it funds itself, or feeds on itself rather. And so far it appears to be working, right? The reading time's going up per user at the same time the daily average user is going up. So it seems to be working. But the thing we don't know is, will it sustain itself after they stop funding all their GMD dollars into S&M? And maybe that we don't know that for a year from now or 2 years from now, right? Depends how far they want to try to keep pushing the growth, pushing the content. But I think this is a very clever way. So I'm pretty sure, like if I were to do an example, I'm pretty sure their AI said we need more fantasy books, our users want more fantasy books. You guys, we're going to do a contest. All you writers write your fantasy books, right? That's kind of how they're going to grow their content. Fairly aggressively, I'd say, 3,000 writers, right? The guidance is very high. Like I said, this is a high revenue. It's not like proof of concept revenue. The revenue's there. Just that we don't know how much is really there after they stop basically putting all the dollars generated back into the company. But at the same time, you kind of want that because it's high growth. And right now it's not priced like high growth. It's priced like it's slowly dying. And we can see that here in the share price. So I started tracking the company, I want to say, when I saw the move up. So maybe around $3 when it shot up to 5, I saw it. And I was like, okay. And I started digging. I was like, oh, this looks pretty interesting, right? And then sure enough, it comes back down. And so I get suckered into buying it right around here, I think. Yeah, 450. No, wait, 372 or something. That's where I'm in. So yeah. So I was like, okay, it's gone down quite a bit. Boom, I get in, catch a knife. Goes right through me. It's 280, and now we're here. And what I want to wait for before I add to the position is I just want to see the Q4 numbers and hopefully see what they're guiding for next year in revenue. because I have no problem waiting to see how this plays out over time, as long as the daily average users keeps going up. Because, I mean, it trades at a fraction of its revenue dollars generated, whereas everything in America, just for context, you can see, well, this software is a service, but you can see, generally speaking, software was trading at 4 times ARR, so ARR is your annual revenue run rate, and you can see trading between 4 times your annual revenue run rate, all the way up to currently where it's trading over 15x annual revenue run rate, right? So very interesting times. So I get a kind of tech company with a similar growth profile that's trading at 0.5 revenue, and they're trading at 16x revenue, so that's a delta of 32x from a multiple perspective. So that's it's kind of like, okay, how much of a discount do you need because it's a Chinese tech company and not an American tech company? So that's kind of the gist of it. It is, I've kind of talked about the risk enough, but it is riskier whenever you're dealing with a country outside your own. At the same time, you don't want home bias, and so you need to keep an open mind. It is a high grower. It'll be very interesting on March 25th what they say on that annual conference call. And I'm sure the Q4 numbers will probably be in line with what they were saying, like 105 million in revenue in the quarter again, US. So again, that puts it at like 450, maybe 445 million in revenue for the year, which is very high year-over-year growth. But I kind of want to see how much growth is there going to be in 2021, and are they going to keep having to spend every dollar that they generate in GMT back into the business to keep growing? What's their time horizon on that? Like, I don't mind if they do it for another year and even another 2 years, but eventually you're going to want to see some money, right? Or else they're going to keep having to finance this with convertible notes. Anyway, I'd like to know your thoughts on it. It's a little bit different than what I normally talk about, so I wanted to go through it a little bit more thoroughly. Yeah, have a great rest of your weekend.